Hello, my friends. Spencer Nelson, Brian Hunsaker, the chairman, Brett Pattison, MIA. We do know where he is, but he's MIA today. So you are going to listen to the podcast with just the two of us. Brian is in the financial capital of the West Salt Lake City. I am up north in Logan, Utah today, but wanted to reach out to everyone to provide kind of an update of, hey, where are things currently? Obviously, it has been an ugly month. The month of September was a very ugly month in the market. We want to provide an update of where things are at and then talk through a couple topics for you. I'm going to share my screen really quickly and just show you kind of where things are at. This is a chart of different asset classes, and you can see from maybe the most conservative of asset classes, gold, which is actually supposed to be a hedge of inflation. And when inflation is roaring, gold is supposed to be going up with it. Well, gold is down almost 11% on the year, 10.83%. Bonds, the aggregate bond index, worst year for bonds since the 1970s, down 16%. S&P 500, you can see right here, down 23%. NASDAQ down 30%, and thought it was very interesting. The longer duration bonds, the 20-year U.S. Treasury bond is down 31% this year. So all asset classes have really gotten hit super, super hard. I would say the NASDAQ is here, but if we go even more speculative, obviously cryptocurrency is down 60, 70, some of them 95%. But I actually saw, Kathy Wood's ARK fund, which is a very kind of tech-heavy, speculative, disruptor type investment, is down about 65% on the year. And so all asset classes have gotten pummeled. But with that being said, it's been a hard year, and it's been really important for us as advisors to talk with clients and communicate as much as possible. And generally, I'm sure the message through the podcast and the message through our individual meetings has been, it's really important to not panic. That is when you make mistakes in investing, and a lot of times a lot of money is lost when you do panic and let emotion drive your decision making. And so we've talked with clients about doing that, but also we wanted to talk about the reverse side. Well, if we're telling clients to not panic and stuff, well, what are we doing? What is IronGate doing as the market has continued to go down? And so, Chairman, what are you doing?
Yeah, that's a great question. I had that exact question yesterday from a longtime client, great client, good friend. What are we doing? What are you doing to protect my money? What are you doing to protect my wealth? And that's a great question. I often, those that have listened to our podcast over the years know that I've been doing this a long time, over 30 years. And I've been through some ups and downs in the market, and the financial crisis, the dot-com boom and bust. I've seen those things, and my experience, because of those traumatic and dramatic market events and economic events, has taught me over the years to build really, really strong portfolios that can withstand an earthquake, or like Florida's experiencing right now, a hurricane. And those are the type of portfolios, another analogy is a bulletproof portfolios or businesses that can withstand terrible economic downturns and declines in the market and economic activity. So that's the kind of portfolio that we are building. So I guess part of the answer to that question, Spencer, is we've done our homework ahead of time in preparation for these hard economic times. And then on top of that, we are constantly poking holes in our ideas and in our investments and companies that we own, and trying to find cracks in the foundation. are there problems or potential problems down the road with this particular investment or that particular investment? And if you've looked at our activity, if you've been a client of ours for more than 6 months or a year or so, you'll notice that we do make changes in the portfolio. We are not active traders. We're not buying and selling on a daily basis. We're investors. We're long-term investors, but we own great businesses. I always think of myself as a business owner, but we're constantly poking holes or trying to find cracks in the foundation of the businesses we own. And we found, on occasion, we find them. And when we find cracks that really concern us in that foundation, we will make a change. And we've done that in the past, and we will continue to do that. And then in addition to that, we are always looking for newer and better ideas, better opportunities than what we currently own. If we find something that looks, it meets all three of our criteria, except for maybe the valuation, we're constantly monitoring and watching for those ideas. And then if the price becomes attractive, even more attractive than what we currently own, then we may make a switch. So that's how I would answer that question.
Well, and I think that that's important in the sense that we really believe in the companies that we have currently in our portfolio because of the amount of time and research that's gone into it. And earnings season just finished up within the last month. And so we were reviewing all of that data that came from earnings seasons to see, okay, how are these companies doing? But you're absolutely right. There are a whole bunch of other companies. I wouldn't say tons, but there's a handful of other companies that we have looked at and really believed in, but they've been way too expensive. And so this has given us an opportunity to reevaluate the valuation on those to say, okay, do we think company B could produce a better return over the next 3 to 5 years than what we currently have, and make that evaluation. One thing that you said to me, I'm thinking about it right now. Everyone knows interest rates are going up. The 30-year mortgage tipped above 7% the other day. And when it comes to real estate, we know with mortgage rates coming up, whether it be on the residential side or commercial side, prices will start to come down. So real estate, what do they always say in terms of buying good real estate? Go ahead and say it, Brian.
Location, location, location.
Location, location, location. When it comes to stocks, what would you say is the key to be able to withstand these hurricanes and everything? What would you say for that?
Well, when I was talking to this customer yesterday, this is what I told him. I gave this same analogy. I said, in real estate, it's location, location, location. In stocks or owning a business, it's quality, quality, quality. We want to own high quality businesses. I always, I have a sports background. You have a sports background. I always wanted to build a Hall of Fame football team with just the best quarterback of all time, the best offensive lineman, defensive lineman, running back, receivers, go down. That's the kind of team that we're trying to put on the field at Iron Gate with our businesses. We're trying to build an all-star portfolio of businesses. And I think we've done that. I mean, for the most part. Now, some companies may never be a Hall of Fame type business, but a good business. But that's what we're looking for, is great businesses, Hall of Fame, the sports analogy, Hall of Fame type businesses.
So that's what we're doing. I mean, really, we're evaluating the companies that are currently in our portfolio and then evaluating other opportunities to see if we think they will generate better returns for our clients moving forward. With that, there's also the emotion side of it. And clients, we're not immune from the emotion side of all of it. And as we see the market go down, absolutely, there's discouragement there and frustration and all of those things. But it is so important that as an investment committee and as partners, we're constantly discussing about making sure we aren't making mistakes. We're not letting emotion drive our decisions. I know the other day we were listening to a Ken Griffin interview, and I think you had a quote that kind of talked about making sure you don't make mistakes. and making sure it's something that could lead to mistakes if you get in a liquidity crunch. Do you want to talk about that, Brian?
Yeah. So the question that was posed to Ken Griffin in an interview, just I think it was yesterday, about there was a smart, very smart investor that was basically making a prediction or forecast that the stock market may not be very attractive.
There could be a hard landing, is what he was saying.
Could be a
There could be a hard
recession.
landing in the recession, and that could take the market even lower.
Right. Yeah, it could be a recession in 2023, and that the market may be difficult place to make money over the next several years. And Ken Griffin said, "Yeah, I mean, that's a possibility. It's for sure a possibility." He said it was, more. He's actually was trained as an economist or studied as economics at Harvard, and he said, those things are very hard to predict, but it is a possibility. There is some chance that we'll have a recession, but he says what's more important is think about your portfolio, and is it currently invested so that you can stay invested during downturns. The worst thing that can happen is that you are forced to sell when the markets are down. So is your portfolio designed so you can withstand market downturns, withstand that hurricane or that earthquake that will come? As if you're a long-term investor, you will go through a hurricane or an earthquake at some point. Is your portfolio, are you positioned so that your portfolio, that you don't have to sell when markets are down? That's the worst thing that you can do, and really destroy wealth when you're selling at market bottoms.
Yeah, and that goes actually to planning beforehand and recognizing, okay, this money that we have here is long-term money. I need to keep some liquidity in a bank account or whatever as an emergency fund, but making sure you don't have one of those liquidity crunches that you're forced to sell. Now, obviously, emotion and all of those things can influence that, but it's our responsibility to, one of the best things we can do for clients, not only pick great businesses and invest in them, but help protect people from making mistakes. And so from a financial planning standpoint, that's what a lot of I do, is making sure that we put a plan in place. And it's been interesting as I've met with clients recently, and they've kind of been expecting to get bad news from a financial planning standpoint, meaning the probability of success in the future of them retiring when they want to has gone down. And they've been surprised because in most cases it hasn't. And they're like, well, why hasn't it gone down? And the key is because we plan for these types of events. We don't build a financial plan that has everything perfect and the market's going to go up 8% per year every year, and that's going to think. Anyone can build a financial plan that will do well in good times, but a really good financial plan, and I think this is what Ken Griffin was speaking to, having a plan that is expecting or planning for these types of events and making sure that even through these types of events, people aren't forced to liquidate, aren't forced to make mistakes, so they can continue to stay the course. And so for us, encouraging clients to making sure that there's a plan in place, and if there's not, you can call us and happy to meet with me or my team. And then also knowing that we at IronGate are working, as hard as we can to make sure that the businesses we own, we've put together an all-star portfolio, and to see if we can make any trades. If we can get rid of Donovan Mitchell for 40 draft picks or whatever it is, type of thing, we're going to be greedier than Danny Ainge on those draft picks type of thing in terms of switching it out. But we really want to construct a portfolio that's bulletproof, like you said, Brian, because guess what? Our portfolio is the exact same. My personal portfolio, Brian's personal portfolio is the exact same portfolio as our clients. And so it's not easy to go through these tough times, but we plan for them and we ride through them. And then if opportunities are created with other businesses, we're going to make those changes. I don't know if you have anything else to say, Brian.
I think that's a perfect summary of basically what we're trying to say and communicate to people. One thing I would just say about risk and planning, and where you really get, it's kind of the flip side of what we're doing, but where you can get in real trouble and being forced to sell in tough markets is when you have a lot of leverage. And that is just a big dangerous thing that you should avoid at all times. People with big margin balances or leverage, that's where you get wiped out. And so that's just a warning, just to beware of that, and be very careful. It's playing with fire.
Yep, absolutely. Well, hey, thank you for tuning in to our podcast. Two pretty faces. You didn't have to look at Brett today. You missed him. We missed him, and I'm sure
we missed
he'll
him.
be back next time. But thanks so much, Brian.
Thank you.
Have a great day, everyone. Bye-bye.
Bye.